There are various ways in which people finance businesses. The most common ways that people finance a small business are: number one, loans from family or friends. Having family, parents, or friends who can help you in a simple way to finance a business as long as the commitments you make to these people are honored. Terms of interest and repayment should be made clear and always put in writing. The benefit of these loans is that family members are often flexible if repayments cannot be made on time, and usually they require little interest or low rates, and sometimes without the interest. Loans from friends can be trickier and are not advised unless you do not value the friendship. There is no better way to ruin a good relationship than unpaid debts. Think carefully and decide which is more important to you, your business or your friends. Don't risk your friends to guarantee a loan for you. This can also ultimately ruin a friendship. Number second, this is about increased home mortgages. In cases where banks have refused a business loan, many people resort to placing a second mortgage on their home or increasing their first mortgage. A word of warning: it is a long term battle to regain home equity, yet, it can be easily lost with a new mortgage for a business that doesn't meet expectations. You will be left with a large mortgage payment, business debts, perhaps no immediate work prospects, and the possibility of the bank for closing on your home. Many marriages have dissolved for this reason. Think carefully about these risks unless your new business has guaranteed immediate income and profits. Owning your home is paramount to your financial well being. Would you threaten the security of your home and family for a business? Business is a gamble, even when you have a good poker hand. If you do decide to remortgage your home, remember that the business portion of the interest paid is tax deductible, just as any form of loan interest is. Number 3. Lines of credit from the bank. For small loans, a line of credit is a good source of reasonably priced financing. The interest rate will fluctuate based on current rates and is usually 2% higher than a mortgage. The line of credit will be repaid more quickly than a mortgage, but you must be sure that you can make the monthly payment. If your loan is secured, repayment amounts can be structured to suit your budget and the emergency situations. You can pay the interest portion only. Number 4 is credit cards. They should be last resort for financing. If you are that desperate for financing, you shouldn't be starting a business. Credit cards carry exorbitant interest rates as high as 21%. For short term financing, they may come in handy, but in what price? Credit cards give you a false sense of security because they allow you to make minimum monthly payments, At the same time, the interest is compounding on the interest at an alarming rate. Many businesses use credit cards to pay for supplies and startup costs, so if you have to use them, keep strict control over your spending habits. Use them as a 30-day interest-free short-term loan to the business. Treat each purchase as a check which you are writing from your business account. Post dating that check for 30 days. If your cash flow can cover that check charge, if your cash flow can cover that check, charge it. If it cannot, don't. The principle is that if you can't afford to buy it now for cash, you can't afford to charge it. It is common sense to allow yourself 30 days credit, no more. Otherwise, you will be paying over and over again for the privilege of using the bank's money. If you have trouble controlling your plastic purchases, either cut your cards up or freeze them in a block of ice. It is called freezing your liabilities. Number 5. Banks. Banks prefer not to finance a small business loan. The amount of time spent processing the paperwork and the small amount of interest earned from the transaction doesn't provide enough profit for the bank. They are likely to steer you toward a limit of credit or even remortgaging your home for smaller amounts. They also don't like to lend for money capital only, preferring to invest in tangible business assets such as new equipment, improvements, or buildings. No matter what kind of loan you want from the bank, you have to be well prepared and present your plan professionally. Don't go to your appointment in jeans and sneakers, unshaven and chewing gum. You need to be financially prepared with a sound business plan, a statement of personal assets and liabilities, and proof of income earned in the last taxation year. On speaking to business loan managers, the, the consensus is that the average borrower comes is unprepared. Few have business plans or have calculated whether they have the ability to repay the loan. When you call for an appointment, ask what information will be needed and prepare it in a professional manner. Now is number 6, small business loans. Your business may be eligible for a small business loan offered through some government program for small businesses to help new and existing businesses obtain financing from chartered banks. The funds can be used only to improve or purchase fixed assets, such as equipment or buildings. You cannot borrow to finance inventory, goodwill, franchise, fees, or shares. They are either intangible or expendable items. Both sole proprietorship and incorporated businesses are eligible for such programs normally. Number 7. Finance companies and brokers. Alternative finance companies are often willing to lend money with fewer security requirements than a bank demands, but you have to pay um, enormous, exorbitant interest rates. Some people have obtained second mortgages from finance companies, ultimately paying just interest without appearing to reduce the principal amount. that these companies, as you would treat credit and financing, proceed with extreme caution and preferably avoid this type of financing altogether for your business. Number 8. Government funded programs. Numerous government funded programs should be available to businesses covering such areas as research and development, export, manufacturing, processing, environmental, agriculture, training, and management. Some are provincial and other may be federal. So, number 9 is term loan. If you have a profitable venture which needs financing, the financial institution can offer help in the areas of working capital, purchase of land, buildings, or equipment, and refinancing and upgrading of equipment or commercial premises. These loans are usually secured by fixed assets. Number 10. Working capital for growth loan. Small to medium sized businesses may qualify for this loan. This is designed to add to financing from conventional lenders. If you have identified new areas or opportunities for growth with your business and require working capital, this loan may interest you. You must be able to provide proof for sound management, have a complete business plan prepared, prove past performance in the business, and show strong potential for profits in the future. 11 is Number 11 is micro business program. With a combination of mentoring, counseling, and financing, this loan is often available for startup and for existing businesses. It can be used for assets, working capital, startup costs, research, and franchise purchases. A sound business plan is essential. And the final one is venture capital and loans. Venture capital is money obtained through investors who, in return for their investment in your company, usually expect a share of your business. This share is commonly more than 50%, effectively giving the investors control over the financial decisions and a say in running the business. Venture capital can be hard to find, so expect to spend several months looking for this type of financing. And don't forget to prepare your business plan first. Be aware of what you are giving up in return for someone else's money. You could try approaching friends and associates wanting to invest small amounts of money, offering them a small share of your business in return. You would have to incorporate your business because of the share structure involved. Your projection and cash flow sheets will indicate how much money is needed to get the business rolling. And remember, you are not just taking into consideration the purchase of the business, but also the various setup costs and some working capital. It is risky business starting out entirely on borrowed capital. Remember that always. Ideally, you should be able to invest at least 25% to 30% of your own money. No one can tell you how much to borrow. However, when a loans officer is reviewing your business plan, he or she expects to see you contributing a healthy part of the capital. This proves You have made a serious commitment to the business and have faith in your ability to make it success. If your own capital contribution is not part of a proposal, a bank will ask you why it will not choose to be the sole financer of any business. Only borrow what you can afford to repay. You must be sure that loan repayments can be maintained even if the business does not progress as fast as you had planned. Log on to my website www.asifjmeer.com. I also invite you to visit my blog at asifjmeer.wordpress.com. Have a great day.